You are staring at the 15-minute chart. The RSI shows a textbook divergence. Every tutorial and forum you've ever read is screaming at you to buy. So you execute the trade. You do exactly what you were taught, placing a standard, logical stop loss just a few pips below the obvious support line to protect your downside. In milliseconds, a high-frequency candle wipes out your stop-loss order. The price halts exactly at your boundary. Then, the real pain. The price immediately reverses exactly where you predicted, surging upwards and leaving you behind with a loss. This sequence represents a deliberately engineered market event designed to harvest retail capital. Human-to-human trading in the foreign exchange market is over. Today, predictive high-frequency algorithms dictate roughly 90%. To fill their massive orders, institutions deliberately force the price down into these specific pools, triggering your stop losses to harvest counterparty liquidity. If you are trading with 20th century logic, you aren't a trader. You are the designated exit liquidity for institutional machines. Surviving this ecosystem requires stripping away the retail noise. Standard oscillators like the RSI and MACD are lagging derivatives of price. They can only summarize historical data. They cannot show real-time market intent. In fact, predictive algorithms actively scan for retail oversold signals. When those indicators trigger a surge of retail buy orders, institutions use that exact moment of demand to fill their own massive short positions. Professionals ignore those indicators and track order blocks. These are the true institutional footprints, sharp, impulsive price moves executed specifically to grab liquidity and break market structure. Instead of lagging oscillators, they use VWAP, the volume-weighted average price. It is the only metric that factors in both the price and the actual volume committed by institutions. To survive, you must abandon the tools that show what the retail herd thinks and adopt the footprint tools that prove where institutional money actually is. But even the clearest technical chart pattern is a gamble if it contradicts the overarching flow of global capital. The US dollar index, or DXY, is the primary macro filter of the foreign exchange market. Every trade you take should be filtered through the lens of dollar strength or weakness. Smart money strictly follows yield differentials. They track the spread between the interest paid on US 10-year Treasury bonds and European debt. According to data from the Bank for International Settlements, institutional capital flows follow these yield differentials with absolute precision, especially in high inflation environments. Warming tone. Never execute a technical setup if it fights the DXY or the 2-year yield spread. Smart money follows the interest. Most traders hit a wall at the 18-month mark. The beginner's luck dries up, and they fail the strict drawdown limits of modern evaluation models. Enduring these algorithmic drawdowns requires a shift in identity. You must transition from a trader trying to get rich to a capital manager enforcing a strict 0.5% risk limit per trade. This illustration highlights the physiological threat of modern trading. Entering a high-leverage position floods your body with cortisol, pulling neural activity away from the logical prefrontal cortex and directly down into the amygdala. That biological stress response triggers immediate panic. Your brain abandons its rules, leading straight to the aggressive revenge trading that destroys accounts. Mastering biological stress protocols, like specific breath work or cold exposure, is just as critical to avoiding liquidation as managing your chart setups. The modern algorithmic market is ruthless, but it is highly predictable for those who know how to read liquidity sweeps instead of imaginary trend lines. Audit your recent trading history. Were you hunting the market, or were you serving as its liquidity? Navigating these markets requires specific institutional data to identify order blocks, real-time sentiment analysis to spot retail traps, and execution speeds that match algorithmic pace. FXNX provides this exact stack to help traders align with the market's real drivers. With the necessary tools and an unlearned retail mindset, you can stop functioning as an exit strategy and start trading alongside the machines.